At what price should you start adding PayPal to your portfolio? Well, the first thing you have to understand is why they dropped by 13.41% after reporting their earnings. And in fact, they actually beat their earnings per share by 7 cents, their revenue by 120 million, and their guidance is higher than what the analysts expected. But the stock mainly dropped because of concerns regarding unbranded checkout growth, which in my opinion isn't a good enough reason. Now, something very interesting is that when we compare the earnings per share of PayPal to their price over the past 10 years, you can see that when the EPS was rising, the price was rising as well. When the EPS rose very steeply, the price rose very steeply, and when the EPS fell, the price fell as well. But from 2022, the EPS started rising, but the price of the company stayed quite flat. And so this is one of the reasons why today we will analyze PayPal and figure out at which price you should start buying the company at. So as always, we will jump to my stock valuation spreadsheets where I will plug in the ticker PYPL and all the metrics will show up automatically. And if you want to download these sheets for your own personal use, you can do so at the link in the description. The first thing you can see is that PayPal currently doesn't pay out any dividends, which does make me quite happy as it means that they can push more of their free cash flow into innovation. And in fact, when we jump to pillar 6 and have a look at the profitability of the company, you can see that the return on invested capital rose from 8.8% in 2020 to 10.8% in 2024. That is a big increase. But this is only the first of the 9 pillars we will go through today before calculating the company's intrinsic value using the Graham's formula, discounted cash flow model, and the multiples valuation model. Now, jumping back to the 9-pillar analysis, the company gets a rating of 6 out of 8 with 2 pillars currently sitting in the red, and that is the 5-year PE ratio and the 5-year price to free cash flow. Now, if I zoom in to pillar 1, you can see that over the past 5 years, the PE was sitting at 47.38, but currently it is sitting at only 19.38, which is lower than the average stock PE ratio and therefore in the range we would like it to be in. Now, regarding the price to free cash flow, that is as well sitting at 20.29, which is lower than the 5-year average and in the range we would like it to be in. And this means that PayPal, compared to the free cash flow and compared to the earnings they are generating, would be considered undervalued at the price they are currently trading at. Now, what I always like to say is that a company's stock price growth is mainly based on their financial growth. So let's check out PayPal's revenue, free cash flow, and net income growth over the past 5 years. If I zoom into pillar 3, you can see that the revenue grew from 21.5 billion in 2020 to 31.8 billion in 2024. That's a very decent increase within a 5-year period. Now, regarding the net income, that has actually decreased from 4.2 billion to 4.15 billion in 2024. Now, what you have to understand is that PayPal isn't in an extremely fast-growing sector. So when their net income jumped up by almost 50% from 2019 to 2020, I expected it to drop within the next year. But as you can see, that didn't happen, and PayPal actually managed to hold their net income at about 4.2 billion. And them holding their net income in this range is actually accounting for the huge jump from 2019 to 2020. And that's why I don't really mind the net income not growing over the past 5 years. Now, finally, let's look at the free cash flow growth of the company. And as you can see, the free cash flow actually increased from 5.3 billion in 2020 to 6.7 billion in 2024. So that is a great sign. Now, moving back to the 9 pillars, let's have a look at one of my favorite metrics, and that is the decreasing shares outstanding. PayPal over the past 5 years has on average been repurchasing about 2.60% of their shares outstanding every single year. But if I zoom into pillar 7, you can see that in 2023 and 2024 combined, they repurchased about 10% of their total shares outstanding. And in 2025, they're actually planning on pushing another $15 billion of their free cash flow into a stock repurchase program. Now, what you have to understand is why stock repurchase is so important. When a company buys back shares, it means that there are less shares outstanding, and therefore the earnings per share of the company increases and the value of your investment increases as well. Now, when a company such as PayPal is so heavily invested into repurchasing shares, it also tells me that they themselves believe that they are trading undervalued. Now, if you have made it so far into the video, I just want to let you know that I have started teaching investing in online one-on-one sessions. So if you have just started investing and have questions or simply want to learn all about stocks and the stock market, how to value them, when to invest, and which metrics mean what and why they are important, you can sign up by going to the link in the description. We are currently running a 20% discount. Now, before calculating the intrinsic value, let's have a look at one final very important metric, and that is the long-term liabilities over the 5-year free cash flow, which for PayPal is sitting at only 0.66 and means that PayPal really doesn't have that much debt at all. Okay, so now that we have gone through the 9-pillar analysis, everything is looking nice and sweet, but let's calculate the company's intrinsic value and figure out at which price you should start adding the company to your portfolio. So first, jumping to the grams formula revised, we have to plug in the earnings per share growth estimates. So I will plug in the high at 10, medium I will go with 9, and low I will go with 8. And when averaging this out with the analyst predictions, I will get a 5-year earnings growth estimate of 13.39%. I will then combine this with all the other values and get an intrinsic value of $91.10, which is 18% higher than the current trading price. Now, moving to the second valuation model, the discounted cash flow model, we will plug in the free cash flow of the company over the past 5 years and calculate an average growth rate. Now, before calculating the growth rate into the future, I will plug in the growth rate at 0%. And something very interesting I want to point out is that with a growth rate of 0% into the next 10 years plus, the intrinsic value of PayPal would still be sitting at $74.65, which is very close to the current trading price. So if PayPal didn't grow at all into the next 10 years plus, it would still be worth buying below $74. But as I do believe that PayPal will grow, I will plug in the high growth at 7%, medium at 5%, and low at 4%, and averaging this out, I will get a calculated growth rate into the future. I will then use this to calculate the future free cash flow, and plugging in a discount rate at 9.55%, I will calculate the present value of that future free cash flow and get an intrinsic value of $109.19, which is quite higher than the current trading price. Now, for the third valuation model, I want to compare PayPal to two of its competitors. I will take these competitors' current stock prices and divide by their earnings per share to get their PE ratios, which I will average out and multiply by the current EPS of PayPal to get an intrinsic value of $106.78. And finally, we will skip the dividend discount model and arrive straight to the ultimate valuation, where when we average out the three valuation models, we will get an ultimate intrinsic value of $102.36, which is 32.5% higher than the current trading price. And so with a margin of safety of 25%, we would get an acceptable buy price at $76.77, which with its current falling price, PayPal might reach very soon. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.